All right, we're recording, I believe. All right, good morning, everyone. My name is my name is Dan C, and this is my first video. We are going to take you down a bunch of different paths about financial literacy, just the financial markets, some of my favorite books that we're going to look into, all with the goal of giving everyone a better understanding of how the financial markets work, how the stock market works, and to hopefully gain a little knowledge and then empower themselves to grow their own wealth over time and really secure freedom through their own finances, which is kind of in my view what money is all about. Money is it's freedom to do what you want with your time. So before we kind of get into the main thing which we're going to do today, which is review three of my favorite books about finance that I think provide a really good foundation for understanding. I'll just tell you a little bit about myself. So, like I said, my name's Dan. I've worked in financial services for more than a decade, close to 2 decades now. So I think I'm coming up on 18 years of experience. I've worked for some of the biggest financial firms in the world, helping them market and sell their own financial products to big investors, small investors, and everyone in between. And really, I think working in that industry, what I've learned is I've got to work with really smart people. So I've got to hear their ideas, understand their ideas, take their ideas and bring them to other people, which is why I think I wanted to kind of start this channel and really do the same thing for more people, using the benefits of storytelling on video. So that's why I'm here today. And I think I'm going to do some long form videos. This one's going to be pretty long, so buckle up, and then we'll do some shorter ones where we go kind of deeper into some topics, books, some articles, some trends in the market. But if you kind of just think about what's going on, what happened in 2022, now we're in 2023. It's almost March, can't believe it. Inflation is a hot bucket, or a hot item topic. What the Federal Reserve is going to do about interest rates. Anyone who has a mortgage knows that they were paying a very little amount for a mortgage just probably 18 months ago, and now those mortgage rates are significantly higher. So really, like I said, the goal of this is to just give you an understanding of the basic tenets of how the capital markets work, how everything works together, so you can kind of take that knowledge and then navigate your own life, and use it to be the master of your own domain. So I have some notes here, so let me just pull them up and we can get started. 1 second. And I'll get better at, editing videos and everything over time. So bear with me. All right, here we go. So, okay. All right, so what are we going to do today? Today we're going to do a deep dive on 3 books that I think, really will give you a really good understanding of, how the capital markets work, how personal finance works, and really good just, like I said, just our goal is to give you a basic understanding, hopefully pique your interest so you want to learn more. And then over time, you can dive deeper into the subject matters that interest you the most. And my channel will be a resource for that, but there's obviously other tools out there on the internet and elsewhere where you can learn to do more. I think one of the great things about our world now is that if you're interested in a topic, you certainly can. You can learn it as much as you want about it, which is really great. Okay, so the 3 books we're going to do. The first one is, we won't do them in this order, but the first book is A Random Walk Down Wall Street, a time-tested strategy for successful investing by Burton McKeel. The next one's going to be The Big Short by Michael Lewis, which is also a movie that many people may have seen. And then the other one we're going to do is Rich Dad, Poor Dad by Robert Kiyosaki, which is actually the one we're going to start with first because I think it's probably the most accessible out of the 3, and I think provides just a really good foundational understanding for how you should think about your finances and how you should think about navigating money in your own household. First, I'm going to have a sip of water because I'm losing my voice already, and we're only a couple minutes into the video. Oh my gosh. Okay. Excuse me. All right. So, Rich Dad, Poor Dad. Okay, so what is this book about? This book, it's a memoir. So it's written, from the first person point of view, from the author, where he explores his upbringing and the lessons he learned from his two quote-unquote dads. His biological father, who was highly educated but struggled financially, and his best friend's father, who was a successful entrepreneur. One of the key themes here of the book is the importance of financial education, the need to think differently about money. So he argues that traditional education, going to college, everything that you do, you follow the path, right? You go to preschool, you go to kindergarten, you get straight A's, you're told you're great your whole life, and then you go to college and the same thing happens and you graduate and no one's telling me what to do anymore, right? So that traditional path, it's not a good path to teach individuals how to take charge of their own financial education. The book also emphasizes the importance of owning assets that generate cash flow, which in this world is even easier to do than it used to be, right? It used to be back in the day, you think about a couple decades ago when, my dad and my mom were raising their young family. Really the only you can either start a business, a brick and mortar business where you had to go to a store and manage an inventory, which was, a big investment from both a capital perspective and a time perspective, or you could buy real estate, same deal, which you needed capital up front to get a loan and then put a down payment on. Now there's a million things you can do. You can do brands, online businesses. The internet really just kind of took that world and that concept of owning an asset and gave it to so many more people. So I think really this book has stood the test of time because of that. I think that's one of the key tenets of the book: owning assets and that kind of just trading your time for money, which is what a lot of people do in jobs, right? So that's, like I said, one of the key tenets of the book. So instead of also spending money on liabilities, such like things like cars, that you need a car, but do you need like a $100,000 car? Probably not. So things that depreciate in value, instead of giving you value and creating value over time, that's a bad trade-off. So you want to take your money that you earn and put it back into assets that are going to earn money for you over time. And he challenges the assumption and traditional notions of job security and encourages everyone to think about entrepreneurship as a way to achieve financial independence and freedom, right? When you're in charge of generating your own income, you're not relying on, a corporation to give you a paycheck every week. You're in much more control. Obviously things can happen in the market that can, hurt your chances, but you're mostly in control of your own destiny, which I think is a really, really, really important point. And I think one of the most important lessons of the book also is to overcome the fear of failure and to take risks. So here I am on a YouTube video wearing a red sweatshirt. Never done a video before in my life, and maybe I'm failing, maybe I'm not, but I think I wanted to try it because part of the reason I wanted to try it too is I want to help my clients also understand this world and how to make videos. So I can't look them in the eye and say, they can do it. It's something they can do if I can try it myself. So lo and behold, that's why we're here. Where else? I lost my notes after that little. I opened up to you guys. It was real. Okay, here we go. Yeah. So he emphasizes that mistakes and failures, they're a natural part of the learning process, right? Taking risk is necessary to achieve success, but also to learn, right? I think the best way, I've found this throughout my whole career, the best way to learn how to do something is to kind of just roll up your sleeves and do it. I don't want to say you shouldn't have a plan. You should absolutely have a plan for longer term success, but you shouldn't get kind of, paralyzed by fear of not starting, right? Paralysis by analysis is what it's called in the corporate world, I think, right? You just you look at everything that could happen instead of just doing it, seeing what happens, and then adjusting based on the initial outcome. So you kind of test and learn, I think, is a much better way to go. Again, but having that long-term steady plan and trajectory to keep you on course so you don't kind of get too deep into the weeds or go down a rabbit hole. So I think in summary, we're going to do a deeper dive on a couple chapters here, but Rich Dad Poor Dad, great first book to start with, a book that can really, really, really help you shift your mindset about money and empower you to take control of your financial future. So definitely encourage you to check it out. And I think I want to dive deep into a few of my favorite chapters. So chapter 5 is titled "The Rich Invent Money," which I think is a great title, and it's all about the importance of creativity and innovation when it comes to building wealth. So here in this chapter, the author argues that the wealthy are not necessarily smarter or more talented than the rest of us. Again, you think about his biological father, traditional education, by all intents and purposes, very successful from the outside. But when he thinks of his best friend's dad, I guess his adopted father, he was just more creative when it came to making money, right? Like he didn't work a regular 9 to 5. He thought about other ways to make money. And he tells the story about how his rich dad, who was an entrepreneur, once advised him to stop saying, "I can't afford it," and to start asking, "How can I afford it?" Right? So what are the steps? It's the idea that, nothing is out of reach if you kind of think creatively and come up with innovative solutions around topics. You set a goal and you can achieve it. I think you just need to. A lot of people don't set the goal. That's the initial point. They just think, "Oh, I can't do that because of my situation," instead of, "I want to do this. How can I get there?" I think that's a really important, simple but important mind shift. And according to the author, and I think I totally agree, can make all the difference when it comes to building wealth. Another one of the key takeaways from chapter 5 is the importance of looking for opportunities to create value and solve problems. So here, Kiyosaki argues that the most successful entrepreneurs are those who are able to identify a need in the marketplace, right, and create a solution for it. He also emphasizes the importance of taking calculated risks and being willing to fail. He argues that the fear of failure can hold us back from pursuing our dreams, and that the most successful entrepreneurs are those who are willing to take risks and learn from their mistakes. So that idea of not being scared to fail, and just learning from things as you do them. And I guess it's kind of become a cliche at this point, right? Like the old, it's not a failure, it's an opportunity. But it's more about just learning as you go, right? And not being so focused on the outcome, and focusing on the things you're doing to get to that outcome, and then learning from it, right? That's part of what makes life interesting. And then hang on, I need to pull up, bear with me, I have some notes about another chapter that I love that I just want to bring up for you. 1 second, bear with me, where did I put them? Here they are. Oh yeah, okay, hang on, I promise I'll get better at this as we go. All right, give me 1 second. 1 second. Okay. All right. Okay, here we go. Okay. All right, and the next chapter that I want to highlight in Rich Dad Poor Dad is chapter 2. And this chapter is titled "The Rich Don't Work for Money," which is, kind of a headline-grabbing, kind of clickbaity title. I mean, everyone works for money, right? You put in the work. I think it's the mindset here is more about you don't work for a paycheck. You work to better understand the things that you're interested in. You work for learning, and that over time will translate into money, right? That's the kind of the general idea of the chapter. So here he argues again. He's very much about challenging traditional ideas about how you make money, which I think is just interesting in general. But in this chapter in particular, he really does it. So he argues that the traditional model of working for a salary or an hourly wage is a rat race, right? I've once heard the term the rat race, right? It's kind of a race to the bottom, and it can be difficult to escape, right? You kind of you get used to just a certain amount of money coming in, you have a certain amount of expenses, and you kind of, the two never really get too out of balance. I mean, you hope they don't, but you're you're just trading your time to keep up with those expenses, and kind of you just do that, and hopefully along the way you stock up a little bit for retirement, and you get to enjoy a little bit of retirement when you retire in some distance down the road, rather than learning about things you're interested in, having enough money, having money come in from those interests as you become a subject matter expert over time, and then really your day is not defined by trading your time for a task. It's defined by doing what you're good at, and then giving that value away to others because you've built up a knowledge base over time, right? So I think he encourages the readers, and this resonated with me, to think differently about money, and focusing again on acquiring assets and knowledge that over time can then generate cash flow, which I think is really important. I just need some coffee, excuse me. Another key takeaway from chapter 2, which is called The Rich Don't Work for Money. It's the importance of understanding the difference between assets and liabilities. And the author defines assets as the things that put money in your pocket, a rental property, stocks, unpaid dividends, a brand in today's world. Liabilities, on the other hand, are the things that take money out of your pocket. So, credit card payment, car payment, if a loan that isn't then put into an asset that's going to generate cash flow, like a mortgage or something like that. These things are taking money from you. Not to say that you shouldn't spend money on the things that make you happy. It's just you should think about making your money work more for you on the asset side and generating cash flow versus taking on too many liabilities all at once, right? And I think he emphasizes the importance of focusing on acquiring assets that generate passive income rather than simply, again, working harder and harder for a paycheck. And that idea of passive income, I don't really like it, because the passive implies that you don't need to do anything and that you kind of just show up one day and you make money, and that's like really not how it works at all. Passive income to me is more of it's kind of like a trophy at the end of a really, really long journey where you learned a ton. And you take that knowledge and you give it to someone who sees value in that knowledge, and you kind of earn an income stream off of that, right? And he also kind of does a little bit of a classic exploration here, and argues that the middle class focuses on acquiring liabilities and require ongoing expenses, whereas the wealthy, they acquire assets, right? And they pass it down to their children, hopefully, right? So that's kind of the idea here. So you could do the same thing. Another really important lesson in chapter 2 is the importance of financial education, which is, again, I think why this is one of my favorite chapters. And I kind of take for granted that I've learned a ton over the past 2 decades, but I knew nothing when I started out. And I think a lot of people who are in different areas of work are kind of in the same boat, and maybe have some superficial knowledge about finance and investing, but they really don't know too much. So I think the power of just arming yourself with that information so you can make better decisions that over time will add up to increase your wealth is really, really, really important. And it's, at the time when you wrote the book, you said it's up to individuals to take charge of their financial education. But now, you have so many resources available. Hopefully this channel will be a resource to you, but others as well, right? Books and videos and courses and webinars, and you don't need to go to Harvard to get an MBA in finance anymore to learn about finance. In fact, that's probably, unless you're trying to be an investment banker, it's probably a horrible waste of money. There's much easier ways to learn about finance and learn about investing. So really, I think and one of the other big things is to seek out mentors, right? So it's great to learn from online sources, but to actually have a mentor where you could ask very specific questions to, someone you trust, someone who is wise, and someone who you admire in terms of the life that they built. That is really, really important. And I think obviously, Rich Dad Poor Dad, right? Like he sought out someone who was unlike, he didn't see the life that he wanted in his own immediate nuclear family, so he sought out someone who he thought was like, oh, that seems interesting to me. And he learned from that person, and I think that's a really, really important lesson. And if you can find that person, you're lucky, and 2, you should do everything you can to nurture that relationship. So I think in summary, Chapter 2 of Rich Dad, Poor Dad. Powerful reminder of the importance of thinking differently about money and focusing on acquiring assets that generate income, as opposed to putting all your money into liabilities that just kind of keep you paying expenses for a set period of time. And overall, like I said, Rich Dad, Poor Dad, really, really good foundational book, to just kind of just change your mindset about how you think about how you trade your time for money, and like how you should basically spend your time during the day and what you should focus on. So I think it's a really good compass for that. And that's book number 1. So let's get down to book number 2. But I'm gonna have another sip of water. Hang on here. Sorry, bear with me. Okay. All right, where are we here? Let's see. Okay. All right. All right, so next up on our list, it's a book called A Random Walk Down Wall Street, The Time-Tested Strategy for Successful Investing, by a gentleman named Burton Malkiel. Another great book, a little bit more technical and a little bit more kind of in the weeds about what happens on Wall Street. So we're going to do this one and then The Big Short after, which is definitely in the weeds about Wall Street, but he does a really, really good job, Michael Lewis does, connecting it to quote unquote Main Street and storytelling. So I think it's a good one to kind of do this one first and then, end with The Big Short. So bear with me. All right, so Random Walk Down Wall Street, Time-Tested Strategy for Successful Investing. All right, so we're going to do a quick summary here, and then we're going to get into each of the 4 sections of the book. So the book emphasizes that trying to time the stock market is kind of a useless exercise. It's almost impossible to consistently predict, whether the market's going to go up, whether the market's going to go down. Instead, the author advocates for a passive investment approach through index funds, which can, he said, yield higher returns over the long run. Index funds, I think, at the time when he wrote this book, probably weren't as popular as they are now, but if you think about the really big index funds in the world, like there's trillions of dollars going to these, and what they do is they just track the stock market. They don't try to beat it. So they're not a person in a room trying to pick stocks that may go to zero. They're investing in a bunch of different stocks that represent all of the companies, public companies, in a given market, whether it's in the United States or even the entire world. So the idea is that over time that passive investment strategy is going to be more successful, and a lot of studies have proven that it actually is. So the book also highlights the importance of diversification. So that's the idea of investing in a variety of different assets that can help reduce risk and volatility. So if you think about just investing since COVID, and you think what happened at COVID, we take the energy sector as an example. So when COVID hit, the world stopped traveling. The price of oil went to like zero almost, and it didn't go to zero, but it went really, really low. Energy stocks went way down. And if you own just energy stocks, you were in a lot of trouble. You would have lost, a lot of money, right? And then you think to the flip side of that, energy rebounds when the world opens up, demand for oil is back, and then the war in Ukraine happens, and there's concerns about supply, so the price of oil shoots up. So energy goes, and you don't want to be on that roller coaster, right? Because one, you're probably going to be tempted to sell when you're down here. You're going to lose a lot of money, but also when you go down, it takes a long time to get back up to where you were. So the idea of diversification is that if you take your capital and spread it out across a bunch of different assets that are in different industries, you will be less exposed to any kind of one shock that could really, really take your whole entire portfolio down. So that's the idea of diversification. I think he does a really good job in this book, and we'll get into it a little later. In the summary here, another key concept he talks about is something what he calls the efficient market hypothesis, which suggests that the price of stocks is already incorporated, and there's all publicly available information, right? So that the market is efficient and represents that information at all times. So that kind of goes to the idea why he thinks you should own passive index funds, right? So the idea it's difficult to consistently outperform the market as the prices of stocks already reflect all known information, right? So I think that's a very important topic too. He also discusses the importance of understanding fees when investing, right? So high fees can eat into investment returns, and just basically understand, like anything, like if you're paying someone to manage your money, you should understand what you're getting for that fee over time, right? So I think that's a really important thing too. And then finally, I think in summary here, and then we'll get into some of the sections in detail, the book highlights the importance of investing for the long term, right? So he emphasizes that investing is a marathon, not a sprint, and that it's essential to maintain a long-term investment strategy to maximize returns. So this idea of not getting caught up in kind of 24/7 breaking news, right? Checking your portfolio balance every single day. It's a really, really bad thing to do. You just get, you invest, you agree on a strategy, you definitely check in to make sure that it's doing what you thought it would do, but you test it over longer time periods, right? So you don't test it every day, you don't test it every week. You're looking quarter to quarter, year to year, make sure that you're getting the returns that you think you were going to get, but you don't react to every short little blip, right? So that's kind of it for the summary, but we're going to get into he does it in 4 different parts, so we're going to do a summary of each of the parts too. Let me just see how we're doing here. Okay, 1 second. Let's see here. Okay. That was an echo. That's my bad. All right. Okay. All right, part 1. So part 1 focuses on the concept of efficient markets, which he suggests that, like we said, the price of stocks already incorporates all publicly available information, right? So this means that it's difficult to consistently outperform all the markets as the prices of stocks already reflect all known information. He discusses the 3 forms of market efficiency. So when he says weak, semi-strong, and strong, weak efficiency suggests that the current prices of stocks reflect all past trading information. Semi-strong efficiency suggests that current prices reflect all publicly available information, and strong efficiency suggests that current stock prices reflect all information, including insider information. And he argues that the market is at least semi-strong efficient, meaning that it's difficult to consistently outperform the market by analyzing publicly available information. He provides evidence from various studies that show that most actively managed mutual funds underperform their respective benchmarks. Now, what I'll point out here is that some do, right? Like you can get a really good manager who can consistently outperform, but the majority don't. So if it's hard to pick, right? There's thousands and thousands of different strategies that you can go into. So the argument is that it's better not to beat the market, but just match the market over time, which is shown to give, a good return. He also discusses the concept of the random walk, which suggests that stock prices follow a random pattern and are unpredictable in the short term. This means that trying to kind of time the market or predict short-term fluctuations, like we said, it's useless. And that investors should instead focus on the long term and maintain a consistent investment strategy. So again, that long-term mindset, which is really, really important. He also argues that investing in individual stocks is risky, as it's difficult to predict which stocks will perform well in the long term, and he suggests that investors should instead invest in index funds, which again track the entire market or a specific sector. And the index funds offer broad diversification, right? So I think that's it. So I guess part one summary, is at least the market is at least semi-strong efficient. It's difficult to consistently outperform by just analyzing publicly available information. The concept of the random walk suggests that the stock prices follow, a random pattern and are unpredictable in the short term. Investing in individual stocks is risky, and investors should instead focus on index funds, which offers broad diversification and are low cost compared to actively managed funds. All right, and we're just going to go down here. Okay, let's see how we're doing. Doing good. Okay. Yes. All right. 1 second. Coffee. I should finish my whole coffee before I did this thing, but give me a second. All right. Part 2 of the book focuses on the different types of investments that are available to investors. I think this is a really good way to orient yourself with how you can, if you think back to Rich Dad, Poor Dad, do that, generate that, assets that generate passive income. And he starts by, he discusses the pros and cons of each, right? And how they can be used to build a diversified portfolio. And he starts by discussing stocks, which he argues are the most volatile, but also have the highest potential or the most potential for high returns over the long term. And he emphasizes the importance of diversification within the stock market. Again, diversification, key theme here. Suggests that investors, again, buy index funds rather than try to beat the entire market. And he also discusses bonds, which he suggests are less volatile than stocks, but offer lower returns. Anyone who invested in bonds in 2022 is probably saying, well, that's crazy. I lost a lot of money in bonds, but bonds over time have proven to be less volatile, but, they do give you a return, but not as high as stocks. And I think the 2022 performance of bonds is a good reminder of why you need to think long-term, right? And look at long-term returns. If you're going to build wealth over time, you shouldn't hold things for just 1 year. You need to have a longer term investment horizon. And if you need that money in 1 year, you shouldn't put it in the market. You should put it in, either the bank in cash or in a CD, something that's not going to fluctuate when you need to take it out, because the prices of a stock or a bond can change rapidly in 1 year, but over time it will be steadier. He also, again, what happened with bonds in 2022. So he goes into a little bit about interest rates and how that affects bonds. And when interest rates rise, which is what we saw in 2022, bond prices typically go down. And when they rise from a really low level and they rise quickly, it's even worse, which is exactly what happened in 2022. He also discusses, sorry, I'm losing my voice here. 1 second. He also discusses real estate as an investment option here. Real estate can be a good investment option for anyone trying to look to generate income or as a hedge against inflation, right? And I think, what I would add here is there are other assets to include now in this world that we live in. There's brands, there's different ways, there's online businesses, ways where, that weren't available to maybe our parents' generation in terms of the quote unquote side hustles that they could do to earn income. That you can start with just knowledge, and you don't need a lot of capital to start, which I think is really great. And then next up is part 3. I just need to find my notes. It says part 3, yeah. Coffee. All right. Part 3 of the book focuses on the practical aspects of investing, including how to create a diversified portfolio, how to manage risk, and how to minimize taxes. So it's I think a little bit more technical, but again, diversification. You should invest in a mix of different asset classes. So I think in part two, he gives you a good foundational knowledge of like the different ingredients you have to invest in those, to build a diversified portfolio, and then how you can. This is how you can kind of pick and choose those to make it the most efficient, most most efficient portfolio as possible. He also discusses in this section risk management, and he suggests that investors should consider their risk tolerance when creating their investment portfolio, which is really important, right? Because if you set out for something that could lose a lot of money, and you're not really prepared for that when it happens, it could cause you to make an emotional decision that is not in your best interest. So understanding what you're investing in, understanding how it can perform in different market scenarios, and then understanding what your own reaction will be to that, I think is going to be, it's a really, really important lesson to learn, and one that's not easy to learn. So I think, again, going back to the importance of financial literacy, financial education, and just having that knowledge to know how things are going to perform, how they should perform, are they performing to expectations, I think is really, 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 really important. And then he also discusses the importance of minimizing taxes and all the vehicles that we have to do that. So whether it's a 401k, if you work a traditional job, it's a great tax efficient way to do that. An IRA is another tax efficient way to invest for the long term and take advantage of tax deferred growth, right? The power of compound interest over time. The idea is if you start with a little, you earn more. That percentage return increase, it goes and then it goes up high. So the idea of letting your money grow, your tax deferred money grow, is a powerful way to create wealth over time. He also here touches on some common investing myths, including of the idea that you can beat the market, that past performance predicts future returns. And again, I would argue that some people can beat the market. They have proven that they can beat the market over time. So I think that in my view, this is taken with not the majority don't beat the market. Some do, but the likelihood of finding those people that do is, it's hard. But I disagree with them slightly on this point because I have seen many, but investment managers beat the market consistently over time. But his point is that most of them don't. So don't waste your time trying to find the ones who do. And then the last thing is, yeah. So this is really, really important, and this is touched on in a lot of other financial books as well. But staying disciplined and removing emotion from the decision making process. So the way that you remove emotion from decision making is knowledge, right? I think that's why, again, it's part of the reason why I'm doing this, right? When you know more, you're less likely to react emotionally. When you don't know more, you're kind of just going to go with your gut and do things that are maybe not be in your best interest. So the more you know, the less emotional you'll be. You have a plan. It's logical. It's well thought out. Yes, your plan will be tested. Yes, you should definitely adjust if the facts change or if your goals change. But if you know your plan to begin with, you're much like how things should play out in different scenarios. You're much less likely to kind of have a knee-jerk reaction when there is volatility in the market. So I think that importance of taking emotion out through knowledge is really, 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 really important. And again, just stay disciplined, focus on the long term. I think there's a lot of practical advice in section number 3 in terms of the different vehicles available for you for tax deferred growth, but also like how your mindset for thinking about how you should invest. All right, and then we're going to go to section number 4. Okay. Again, this is Random Walk Down Wall Street, the time-tested strategy for successful investing. And part 4 of the book focuses on the concept of market efficiency and its implications for investors. Again, he already kind of laid the foundation for his different, flavors of efficiency, but he argues that, all the investors have the same knowledge, so everyone trading stocks back and forth, those stocks reflect the prices of those stocks reflect the knowledge that is available to everyone, right? Um, so again, he touches on the weak, semi-strong, and strong forms. Argues again that it's largely semi-strong efficient, right? But he goes in a little deeper about the role of professional investors, which would be like people who manage mutual funds, people who manage hedge funds, in the stock market, and that like here he does say that while some do outperform and some do have skill, over the long term, most of them don't, right? That most of them underperform for various reasons, one way or another. So again, you're just kind of bringing home the idea that you want to just do just index funds, and just passive investing, if you're going to gain access to stocks. But again, do your own research. And I think if you take away for me, the key point here is that knowledge is power, right? If you have the knowledge to build a diversified portfolio, how you build that portfolio is up to you, and it's based on your tolerance for risk and your financial goals. So I think again, just another really good tool to build your financial foundation, in terms of your knowledge. And that's it for book number 2. All right, so I think I'm running low on coffee here. I'm not gonna go make another pot in the middle of filming, but I am gonna have a sip. All right. All right. How we doing here? I think we're doing pretty good. Okay. All right. Next up, The Big Short by Michael Lewis. And there's a lot of books written about the 2008 financial crisis, which is known, I think, as the global financial crisis. But this is certainly one of the most insightful, and I think one of the most entertaining. So Michael Lewis is an absolute master storyteller, which is why this book was turned into a movie, ultimately. But so I'll give a summary and then just do a little bit of a deeper dive into some of my favorite chapters. So the book tells the story of a small group of investors who saw the housing bubble coming back in 2008 and bet against it, ultimately profiting from the economic crash that followed. Again, fascinating read. Really offers a glimpse into the world of finance, Wall Street, and investing, which I think is kind of like, inside baseball, but in a way that's really accessible. So if you want to learn how Wall Street works, I think this is a really, really good book, to kind of let you do that. And the first thing to understand is that the housing bubble was caused by a combination of factors, including loose lending practices, financial deregulation, and the growth of complex financial instruments, such as mortgage-backed securities, right? So investors like Michael Burry, Steve Eisman, and Greg Lippmann, who are kind of like the stars of the show here, saw these flaws in the system, and they started making bets against it. So they bet that everything was going to go down, and when that happened, they would win. So they bought insurance contracts called credit default swaps, and basically, like I said, those are instruments that said that these things called mortgage-backed securities would ultimately fail, and when they did, the value of their credit default swaps would go up. So a little technical, but you can kind of get the general idea. These guys saw, oh, this is bad. Everyone else didn't see that it was so bad, and they were kind of consumed by greed. They bet against the greed, and they ultimately won. But it's not just about the housing bubble and the financial crisis. It's a story about the importance of critical thinking, skepticism, and independent research, which I think is why it's really, really great and kind of goes along with the other ones. So how a professional investor can, you can apply the same thinking as a professional investor, right? It's just like question everything, don't take anything at face value, do your own research. To do your own research, you need a base understanding, and once you have that base understanding, you can really do your own research and draw your own conclusions. There's also the ethical issues that it kind of highlights in the world of finance. And, I guess people say the investors who profited from the crisis did so at the expense of millions of homeowners who lost their homes. So he touches on that a little bit. which is interesting in terms of how the world of Wall Street interacts with the world of government and policy, and then also just what was called quote unquote Main Street America, so people who work in outside of Wall Street. So interesting there. So two of my must-read chapters here are chapters 5 and 6. So chapter 5 of the book follows the story of Greg Lippmann. He was a Deutsche Bank trader who saw the housing market and crisis coming, recognized that the housing market was built on shaking foundational subprime mortgages. So, people who were taking out loans for 5 or 6 houses and obviously not going to be able to afford those loans over time if there's any kind of change in the finances, and that you ultimately still have the risk of default was much higher than what the market believed. So he decided to bet against the housing market by credit default swaps. And why this chapter is interesting is you get to see there's all these systems in place in investment banks and, big investment managers in terms of risk taking. And if you have an idea and you're on a portfolio management team, you have to get that idea, you have to sell that idea internally. So this really shows you how they go about doing that. Because the people internally can be seeing what the market sees, right? So you have to do your own research, draw your own conclusions, and then have the conviction in those conclusions to then take that research. It's very contrarian to your bosses, basically, and be like, no, this is why you guys are wrong, and this is why we're right. And it's a spirited dialogue back and forth, which I think is really interesting, but also has a lot of good lessons for just individual investors as well, right? Because you don't want to just do what the herd is thinking or herd is doing. You want to do kind of what you're doing as well. So I think that's really, really important. And then chapter 6. I'm on a call. Chapter 6. Sorry about that. I interrupted. Chapter 6 introduces the character of Jamie Mai, former doctor turned hedge fund manager. Mai was also one of the few people who recognized the risks in the housing market. And again, this is a kind of interesting because, sorry, I just lost my train of thought there. Former doctor, so not a specialist, someone who outside of the realm of finance, but was able to kind of come into this world and through critical thinking and questioning his commonly held assumptions was able to see the housing market collapse coming and then ultimately profit off of it. So I think really, really fun book to read, really interesting book to read, easy book to read. If you want to go back in time, another great book by Michael Lewis is Liar's Poker. It's his first book, and it's a memoir of his time at Salomon Brothers, a Wall Street investment bank in the 1980s, and he recounts his experiences as a bond salesman and his interactions with his colleagues, all of who are very, very colorful. So same deal, you get to kind of see fascinating glimpse into the culture of Wall Street in the 1980s, where greed and excess were kind of the norm. It explores the cutthroat environment of investment banking, and again, just gives you a really, really kind of good look inside baseball, and it's a really, really cool thing to see. I think The Big Short is definitely it's basically our version of our generation's version of here's the financial crisis kind of shaped the investment world and government policy certainly over the last 15 years since it happened, but this is a look back at kind of the 1980s and kind of the cheap debt boom that fueled Wall Street back then, and he does a really, really good job of just explaining his experiences, and it's written from his own point of view, and he's just a great storyteller. So I say, I know it's the fourth book here, and we're not going to go into deep detail, but I would call it a must read for anyone interested in the world of finance and investing. It's also really, really funny. He's hilarious, and he's even Big Short's funny, but he's even funnier in Larry's Poker. So definitely pick it up. But I'd read The Big Short first, and then maybe do Larry's Poker after that. And I think with that, I think that is the conclusion here of our first video series. And what we're going to be doing over time, I'll be dissecting some other books, kind of pulling out the insights that I think could help you over time, and we'll be doing that in a way that I think hopefully it's practical application. Then if you're interested in the books, you can obviously go and you can read them in full, or you can check out some other books as well. So that's what we're going to be doing here. But stay tuned in the coming days for some other insights and smaller snippets. I'll do it in maybe 5 to 10 minute videos for each chapter, so you guys don't have to watch the whole video. But that's it. I'm excited. I'm excited to do this. I'm excited to learn in this new thing, and that's my alarm. It means I got to be doing something. So take care, guys.